Did you ever wonder how accurate are option screeners? Well, if you've wondered the same, I can't blame you. And that's why a month ago, I ran Barchart's Option Screener against 5 of the biggest names for some of my favorite option strategies. The idea? I wanted to see which trades would end up being profitable and which ones would not. Today, it's almost 30 days later, a few days before the expiration date, and what did we find? Well, to answer that, let's go back a month, September 3rd, 2025. I visited the profile pages of the most traded companies at the time and extracted the default screeners for a selection of my favorite income-generating strategies. By the way, you can find those right here on the left side of every stock or ETF profile page on Barchart. For covered calls, I looked at Nvidia and Apple. For naked puts, I focused on Tesla. And for credit spreads, I tested bear calls on Amazon and bull puts on Alphabet. Now, if you're unfamiliar with any of the strategies that I mentioned, don't worry. I'll give you a brief explanation as I go through this video, so be sure to stick around until the end because I'm sure you're bound to learn something that's going to help you out in your day-to-day trading life. All right, so with all that out of the way, let's start with covered calls. This is one of my favorite and probably the easiest strategies. A call option is a contract that gives the buyer the right but not the obligation to buy a specific asset or an underlying stock or commodity at a specified price or the strike price before or at a specified time or expiration date. All options represent 100 shares of the underlying stock. A covered call strategy generates income by collecting premiums from selling call options on the stocks or ETFs you already own. The goal? Well, you want the stock to stay below the strike so your shares don't get called away. If the stock does trade above the strike price at expiration, you will be assigned, which means you'll be selling your 100 shares for every contract that you sold. It's not so bad. Don't worry, you're going to be getting 100 times your strike price in cold hard cash delivered to your brokerage account for every call option that you sold. Now, Barchart's default covered call screener includes several important details like IV, return percentages, and probabilities. So let's start with Nvidia by clicking on covered call right here under option strategies. Then I'll change the expiration date right here to October 3rd because it's about a month away. And then I'll change the strike selection dropdown right here to show all recommended trades. And there we have it, a list of covered call trades for Nvidia. The first thing I want to point out are these figures right here, probability of profit. But the figure assumes that your shares are called away. Now, if you're anything like me, you don't want that to happen. So what can you use as a measure of profitability that you won't get assigned? Well, the answer is right here, delta. In case you're unfamiliar, delta is an options grade that tells us the relationship between the options value, or the premium, and the asset's price, or more exactly, how much an options premium is expected to change for every $1 in the price of the underlying asset. Long calls have positive delta, meaning if the delta is 0.20 and the underlying moves up by $1, the premium moves up by 20 cents. Short calls, on the other hand, have negative delta, and this is because it's the other side of the trade. So if your short call has a negative 0.20 delta, your position is expected to decrease by 20 cents for every $1 increase in the underlying asset. But I'd say that delta is better used as a shorthand predictor of the probability that the option expires in the money. That same negative 20 delta option corresponds to a roughly 20% chance of the option expiring in the money. Therefore, there's an 80% chance of it expiring out of the money, which is the typical goal when selling covered calls. Now, this isn't a 100% accurate predictor because delta is a moving target. It factors things like how close the option is to the current stock price, time to expiration, and volatility. That's why I prefer to use it when trading covered calls. By the way, delta is usually written in decimal form, like 0.20, but spoken as a full number, like 20. They do mean the same thing. Now, your risk appetite will be different, but as a general rule, -20 delta covered calls and above are usually considered safer from assignment. But again, nothing is set in stone. Just to be clear, when I say above -20, that means -19, -18, and so on. So let's have a look at this $190 strike call right here. It has a -15 delta that trades for $1.17 per share. Above that, and the premiums move lower. And that's because risk and reward go hand in hand. Higher risks means higher premium. Lower risk means lower premium. Now, if we jump to October 1st, we can see that Nvidia today is now trading at $185.71. That means all the trades starting from the $190 strike are out of the money. This is what you want. It means you won't get assigned on any of the trades right here. And sure, premiums may seem smaller, but remember, income generation is about consistency. We want to be able to have repeatable trades with a high chance of profit. That's why taking a smaller profit at the beginning is often better than losing my 100 shares due to assignment. But not all stocks are the same. Just because you pick a -15 delta doesn't mean that a -15 will work on every stock. Let me give you another example with Apple. On September 3rd, Apple stock was trading at $238.47. This $255 strike call has a -15 delta, the same one as Nvidia. However, if we fast forward to October 1st, the stock is now trading at nearly $257, which means any covered calls with strikes above $257, like the 260, the 265, and the 270 strikes, they're all safe from assignment. However, the $255 strike call had a -15 delta, and this trade would have been in the money. So that's two different underlyings with similar delta, but one turned out okay and the other one didn't. What you'll find is that when selling covered calls, different underlyings will perform differently against their delta figures. So what might work for Nvidia may not work for Apple or for any other company for that matter. And that's where experience comes in, and the only way to get that is by trading. Now, if you're not so experienced, I do recommend starting with a paper trading account and use a trading journal so that you understand which trades work best for you. Now, let's move on to short puts, also called naked or cash secured puts. A put option is a contract that gives you the right but not the obligation to sell an asset at a specified price, the strike price, at or before a specified time, known as the expiration date. And on the other side of the trade, you, the seller of the put, undertakes the obligation to buy the asset should the buyer exercise their right. Regardless, you receive a premium at the start of the trade in exchange for this risk. The goal of the naked put is for the underlying to trade above the strike price, allowing you to keep the entire premium. Or in some cases, the objective is to earn income while waiting to buy a stock at your preferred price. Now, one thing about short puts is the delta is positive. And this is because as the underlying moves up, so does the position. So a 20 delta short put means a 20% chance of the option expiring in the money and an 80% chance expiring out of the money. By the way, if you want to know more about earning income by selling puts, check this video up here. Now, let's take a look at some real-world examples, starting with Tesla. As of September 3rd, the stock was trading at $334.09. Based on the screener, trades with a 20 delta had an 80% probability of profit, started at the $300 strike. Fast forward to October 1st, and Tesla's now trading at $454.39. So all the trades on this screen would likely expire out of the money in 2 days from now, letting you keep the full premium without getting assigned. And that's pretty amazing because if you look at this example, last month's $370 strike short put, right here at the very bottom, it was 10% in the money and had a 53.25% chance of profit and came with a $39.40 per share premium, or $3,940 total per contract. If you had sold that one, you'd likely keep that near $4,000 profit in full. Again, this highlights the relationship between risk and reward and how each profile changes depending on the underlying and the current market conditions. Now, let's head on over to bear calls. This is one of my favorites to use in a neutral to bearish market. A bear call spread, also called a call credit spread, is made up of two call options. It involves selling a call and buying another one at a higher strike price at the same time on the same underlying asset with the same expiration date. With this setup, the premium you receive from selling the short call will be higher than what you have paid for the long call, meaning you get a credit right from the get-go. You also get to keep that credit in full as long as the stock trades below the short call strike at expiration. However, if the underlying exceeds the long call strike at expiration, your trade ends at a maximum loss, but it's limited, and I discuss bear calls at length in this video, so be sure to check it out up here. Also, you can access the bear calls screener by clicking vertical spreads right here, and then click on the bear call tab. With that out of the way, let's check out Amazon. On September 3rd, the stock was trading at $225.99. Now, you'll notice that the default display provided for bear call spreads is different from that of covered calls and naked puts. Specifically, this screener now has risk-reward ratios and loss probability. So let's consider loss probability as a metric to watch, with around 20% being the safe level. In this case, trades that start with a $240 strike short call have less than 20% probability of losses. So those are the trades right here. If we jump to October 1st, Amazon is now trading at $219.73, well below the $240 strike. So if you had chosen any of the trades on this screen, you would have likely kept the entire premium in full. Of course, you may pick trades with higher or lower probabilities of loss based on the underlying, your own experience, as well as your own appetite for risk. Another strategy I like is the bull put. A bull put, also known as a short put spread or a put credit spread, is like the bear call. It earns you money right off the bat, but in this case, you sell a put option and then buy another one on the same underlying asset at expiration, but at a lower strike price. It's like a bear call, but in reverse. So in this case, you want the stock to trade above your short put strike so you can keep the full credit. I also covered this strategy at length in my credit spreads video, so if you want to learn more, be sure to check it out up here. Now, let's look at a live example of a bull put starting with Alphabet. And on September 3rd, the stock was trading at $231.10. On the bull put option screener, trades with lower than 20% loss probabilities start at the $215 strike short put. So these trades right here. The rest of the trades have up to a 34% chance of loss for the $225, $220 strike put spread, which is a bit high for me, but may be acceptable for other traders. Now, fast forward to October 1st, and Alphabet is now trading at $240.68. So all the trades on the September 3rd screen are out of the money, which means if you had selected any of them, you'd have likely kept the full premium. But this doesn't mean that you can pick all the trades on the screen. Pay attention to the probabilities. So with all that out of the way, does that mean that Barchart's Option Screener is the most accurate tool for trading options? Well, you may have noticed that I am wearing a Barchart shirt, and you're probably watching this video on our YouTube channel. So it may not surprise you to hear me to say yes to that question. Barchart's Option Screener is a powerful tool. Even the default screeners present some of the most accurate trades that you'll see and have practically endless customizability when you further dive into the screener's full functionality. However, I do need to acknowledge that no tool is 100% foolproof. When markets change, events, they can shift sentiment overnight, which can result in larger than expected moves in the underlying. And that's why I think that trading options based on your own experience combined with Barchart's powerful option screener will give traders the edge that they need in their trading. But What are your thoughts on this? Do you have any questions? Have you tried out our own option screener? Let me know your thoughts in the comments below. And while you're there, if you found this video helpful, do like and subscribe. It'll help others find the video, it'll support the channel, and you won't miss out on any of our future deep dives. Well, folks, that's it for me today. I wanted to thank you so much for watching, and I'll see you next time.